If you haven't rebalanced your investments lately, then you might have a lot more risk than you think you do. Today, you'll learn how out of balance you might be and how rebalancing can reduce the risk inside of your investments. I remember meeting with two potential clients in the fall of 2019 when the stock market was at all-time highs. The first one said, "I'd like to retire in 2 years and I'm a moderate investor." Now, typically that moderate investor would have roughly 60% in the stock market, but it turns out their advisor had them in closer to 90% stocks. The second one said, "I'd like to retire in 6 months and I'm a moderate investor." Their advisor had them in roughly 70% stocks. I told both of them, based on when you need the money and how much risk you'd like to take, you should rebalance your investments and move money from stocks over to bonds. The first one said, "Great." And we rebalanced their investments, brought down the risk based on when they need the money and then how much risk they wanted. The second one said, "I like your ideas, but I want to let it ride for 6 months. I'll call you in April 2020 when we retire." Well, he called me early March 2020, and he says, "I don't think I can retire for at least another year. I need to get ready for that, and I want to cut my risk in half." The first one also called me in March of 2020. He said, "I'm worried about whether I can retire in 2 years, and do I need to cut my risk down?" I got to tell him, "You already did. You planned for this ahead of time, and your risk is already half of what it was before." Now, I'm not telling you to cut your risk in half. I'm not predicting the market will go up or down, although it always goes up and down all the time. What I'm trying to say is that you should always keep an eye on when you need the money and how much risk you're willing to take. And if you haven't rebalanced your investments lately, you might have a lot more risk than you think. Let's go back to the end of 2019. Imagine you have $1 million with 60% in stocks, 40% in bonds. That would be 600 grand in stocks, 40% in bonds, 400 grand in bonds. Now, just to make it easy, let's say all your stocks were in the S&P 500, all your bonds were in the US Aggregate Bond Index. The market dropped in early 2020 and came back. Then it dropped again in 2022 and came back throughout 2023, throughout 2024. If you didn't touch your investments, just left them alone from the end of 2019 till today, on November 1, as I'm recording this, you would have 1,144,000 in stocks and 430,000 in bonds. Your investments would then be 74% stocks. That's not moderate anymore. That's a lot more risk than you sign up for. That's more of like a moderate aggressive investment mix. Now, what if you looked last at your investments at the end of 2021, before stocks and bonds dropped by 20 to 30% in 2022? They came back, started to come back in the fall of 2022, kept coming back throughout 2023 and 2024. If you had started out with $1 million of investments, 60% stocks, 40% bonds back at the end of 2021, that's 600,000 stocks, 400,000 bonds. That would now be 750,000 stocks and 380,000 in bonds. That is 66% in the stock market. More than you sign up for. 60% is what you started with. That's not quite moderate aggressive, but it's approaching that more aggressive side of things. And technically, it's 10% more stocks than you sign up for. If you start out 60%, then 66% is 10% more stocks. Roughly speaking, 10% more risk than you might have thought you had. Now, this is not a market prediction, but it is an investment prescription. And here's the 3 steps you need to take. Don't start with looking at your investments. Number 1, think about when do you need your money. If you need money out of your investments in the next 1 year, 3 years, maybe even 5 to 7 years, decide for yourself how long that is. Those are short-term needs that should be met with short-term investments. Now think about your long-term growth money, the money you want to have up and down in the stock market. How much risk do you want to take? Kind of the standard starting point is that the moderate risk is roughly 60% stocks, 40% bonds. And of course, more conservative is less stocks and more aggressive is more stocks. Now, step 3, finally, take a look at your investments. Look at how much actually is set up for the short term, how much actually is set up for the long term. Make sure you have the right amount in the short term. Perhaps you would be rebalancing long-term money to short term. Look at your growth amount and decide how much risk did you want? How much risk are you actually taking? If you haven't rebalanced for quite a few years, you might have more stocks than you wanted, more stocks than you thought you have. Now, rebalancing is not there to make you money. It's make sure that you actually have the level of risk you want. And it's also there to help you avoid the mistakes of getting greedy when things look good and becoming too afraid when things don't go the way you'd like. Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.